Okay, so I'll begin. Hi guys, welcome to the first apply bytes thing that we're having here. So the purpose of this particular presentation is to discuss this particular financial stability report that RBI does twice a year. It's semi-annual, that is. And the way that we will go about this is that we have three speakers who have strictly divided three particular aspects of the topic between them, and they'll be talking about that particular thing only. Now I know that for most of us, what happens is that we don't understand these particular financial terms and jargon as such in too much depth. So don't worry, that's what this session is about. As much as it is about discussing this particular report, it is about giving you the knowledge of these financial terms, and also making you familiar with the current situation of it. So even if you don't understand each and every financial term in depth, if you understand what the current situation is, then it will be something that will be helpful for you, and that you can read more about and gain more knowledge on if you are interested in it. So I'll tell you this particular report. In this particular report, the first part will be taken up by uh, Kudligi, who will be speaking about the macro financial risk of this particular that this report talks about. So the thing is, he will be talking about how this particular pandemic is going to affect the overall situation that we have, the financial situation that we have, and also he will be just touching upon how the situation is going to affect the financial institutions that we have. Now, building upon that, Vishwas will go on talking about the different kind of institutions, the banks that are there, and he'll be going some more in depth in those. So he will be speaking about the scheduled commercial banks. He will be speaking about the scheduled urban cooperative banks, and he will be talking about the NBFCs. So these three particular institutions he will be discussing, and then he will at the end discuss how this particular financial system is connected. How these cooperate and work together. And lastly, Anjaney will be talking about the regulatory initiatives that are being taken. So, what the government of India or other regulatory bodies are doing to tackle this situation, and what their initiatives have been. So, this is what the report is, and this presentation is going to be about. Hope you gain something out of it. Let's begin.
All right, Anjaney, sorry, Adhiraj, I'd like to thank you for your kind words. So we've structured our presentation as follows. So I'll be going first. I'll give you a brief overview on the PPT itself, and then I'll open the document. So in the document, I'll go through the whole document, and along with me, I'll be explaining the important parts so that you will all understand what I'm saying. And after me, Anjaney and Vishwas will come. So just hold on one sec. I'll share my screen and we can begin. Uh, Yes, I hope the PPT is visible to all of you. And beginning this, so basically, my part revolves around the micro financial risks. So, what my part is about is that we look at the situation that was pre-COVID, how was it going, and then what are the financial and macroeconomic problems that our country specifically is facing due to COVID-19, and a few assumptions, like a few simplifications that all three of us have made here is we are going to be focusing more on the logic and less on the figures. If you want to go over the figures, we are more than happy to discuss the same with you after the PPT. And second is that some of the things we've excluded because the PPT would have been too long otherwise, and we felt that that is not important enough in respect to the context we are trying to set. So these are the two simplifications that we made. So without much further ado, let's begin. So let's begin with a brief overview of the difference in the economy after the COVID-19 has struck, right? So the reason why COVID-19 is unique is that it's an unprecedented shock. All 200 countries have been affected. Unlike, say, the 2007-8 crisis when India was relatively unaffected and lots of countries were not affected, every country in the world has been affected. Second is the demand and supply side shock. The demand has collapsed because people are no longer buying, and the supply side has collapsed because supply cannot take place because of the lockdowns. So this has been very, very bad for the economy. However, the one good thing that we can say as compared to the last global financial crisis of 2007-8 is there has been adequate and quick monetary response. Central banks have stood up to the crisis and they've said, we are here, we're going to respond to the crisis, and these are the solutions we have. The advantage of this is that the economy has relatively bottomed out and stopped going more down relatively quickly. Because of this, financial markets have stabilized. However, due to COVID-19, the major problem here that we need to look at here is that the recession has been caused by a virus, right? We never know when the virus can strike again, and because of that, there's a heightened uncertainty. Uncertainty is the word that you'll keep hearing throughout a presentation, because that is what is running the theme. So other than that, the major reasons are global geopolitical tensions are on the rise, countries are fighting, and the second one is over leveraged non-financial sectors, which basically means that they have too much debt and there is a high risk that they might not be able to repay their debt. Other than that, elevated debt levels, since the banks and governments have responded very quickly. In order to respond with that quickly, they've taken up loans. So these loans are going to come into question as if there's no recovery, they won't be able to repay it. And this has been seen both in businesses and households. Two other features are diminished consumer confidence and high risk aversion. What does diminished consumer confidence means? That since I am worried that I might lose my salary tomorrow, I'm not going to spend. Because I'm not spending, I am further impeding the recovery process. This is diminished consumer confidence. And second is high risk aversion. Again, similar idea. Basically, banks, governments, consumers, no one wants to take risks right now. They want to play it safe. Lackluster demand. Again, because of the high uncertainty that's being presented due to COVID-19, there is a heavy lackluster demand. Now, this was related to overall economy. Let's move towards the financial institutions. So credit growth basically means the amount of loans that a bank is giving. If the amount of loans that the bank is giving is increasing, it means that the economy is good because people want money. Since credit growth is falling, it means two things. Banks are scared of giving money because they feel everyone will default. Second, consumers are also not asking for loans because they don't need it. Both ways, it is bad. And the RBI conducted several simulations, and in the expected simulation, the NPAs are expected to rise to 12.5%, and in worst of scenarios, it may even rise to around 13.7%. Then again, one good thing again is when the financial institutions have taken significantly regulatory actions. They have risen up to the occasion, and they've come and took several actions that has helped stabilize the financial market and kept the flow going. Now, one thing, as we move into August and COVID-19 is slow, even though it's not reduced, but it's slow, we have stopped paying attention to it. The focus is now shifting from trying to stop the pandemic and stop collapse to reviving growth, and that will be the theme that will be seen. And therefore, the overall summary, if you can say, is that high risks are present, but because the response has been good, most of the financial system has been good. So now what I'm going to do is I'm going to shift to the PDF, the FRB report itself, and I'm going to go through it. I've highlighted some parts and you can understand it along with me. Just 1 second. Yes, I hope the PDF is visible. I'll just can someone just send a confirmation in the chat and I'll begin. Is the PDF visible? Can someone? Yeah, okay. It's visible. Okay, so this is the FSB report. What I'm going to do is I've highlighted some select parts and I'll explain them as I move along. It's a little big, so some parts we've removed. Yes. So the first part, which deals with the overview. The overview is again, as I covered. So yeah, this one is the most important one. Macro stress tests are revealed that 12.5% is what we are expected to go to. However, if the macroeconomic environment worsens further, the ratio may escalate to 14.7%, which is bad because India for a long time has been dealing with NPS, and if the GNPA or the gross not performing as non-performing assets increase, it will cause a lot of problems. Moving on from this, I've already covered most of the overview in the PPT itself, so I'll move on to the first chapter. The first chapter is again micro financial risks, and global financial activity has come to a standstill, massive scale, with economy and fiscal stimuli, healthcare and administrative measures, all that I've already mentioned. Let's move on. So, main objective of the policy response, this is important. So the main objective initially has been to keep functioning normally. That is, we wanted to keep the markets function as normally as possible and prevent stability. Initially, if we if we left growth, even if we did not have growth, the more focus was on maintaining stability. And now, as we are starting to restart the economy, the shift is now towards sustainable and inclusive growth. Moving on, yes, the macroeconomic developments and the whole COVID-19 in so COVID-19, the virus has its own trajectory. I'm going to focus on the path that it has taken in the financial markets, right? So the first financial market problem started in January 2020, when panic sell-offs, flights to safety, and wealth erosion in equity market. Basically, I'll explain the basic concept. These are big words, but it's actually very simple. The USA, Europe, and all the advanced economies, they're very safe, but they give you very low returns. Emerging economies like India, Indonesia, and other such countries, we offer higher returns, but the risk is also higher. So what happens in good times? People are willing to take more risks, so money flows into the emerging markets because they want higher returns. However, in bad times, they want low risk. It's fine if they undergo returns, and therefore they go back to advanced economy markets. The problem for emerging economies is that we depend on the money coming into this, because we need the money to get development going. So whenever money leaves our countries, emerging economies, during a problem of crisis, it creates problems. The second one, bond yields fell to record lows. What is a bond? Mostly bonds are issued by, I'm going to talk only about government bonds. There are also private bonds, but I'll focus on government bonds. A government issues a bond, and which basically says, I'm going to hold your money for 1 year, but when I give it to you back to you, I'll give a certain interest to you. It's similar to an FD. Now, why have bond yields fell to record low? Everyone wants money. You sell a bond, you get money. If everyone is selling bonds, then that means that everyone wants money. So that is why the yields have fallen to record lows. In fact, USA gives yields of 0% right now. That is, you'll not get any yield. And there are some economies in Europe which are even giving negative yields. Weakening of demand, again, as COVID-19, because everyone is staying home, there's heightened uncertainty. Weakening of demand. GDP growth in advanced economies, which where it's lower, has can range from minus 3.4% to minus 14.2%. Emerging markets where growth is higher because our base of the economy is smaller, it can range from anywhere from 2.9 to minus 6.8%. Right now, the prediction by Nomura and most others is that India is going to expect anything between minus 3 to 7%, with the most optimistic scenario some people are saying is minus 1%, but the general consensus is that we will see negative growth. A major problem that because of the lockdowns is that the manufacturing sector has collapsed. This is a big problem, and after April we have slowly started to ease back, but there's still a problem in the manufacturing sector. Why? Because supply chains are affected, and second, no one is buying. Two reasons: you can't even supply, you can't even buy. Then crude oil price crude oil prices are also falling. Again, this is a crisis that was widely noted, that the Brent futures went into negative. However, because significant measures have been taken, production has been cut down by the major economies, and demand is slightly increasing from China and India again. The price is recovering. I think the price is around $40 per barrel. Now, global trade contraction expected. Global output would contract by 4.9%. All are expected. This is a very interesting word, double hit scenario. So, a key feature of the virus is that a lot of people are expecting that as the winter strikes, the coronavirus will strike again. So, what happens if it strikes again? The situation will be worse, because then people have to again go back to their homes. So, so whenever any macroeconomist is taking out predictions, they're predicting in two ways. One is a single hit scenario where this single hit was the one that's already hit us, and the second is a double hit scenario where in the in the winters of 2020 and 2021 the virus will hit again. So these are the broad two projections that are taking place. Again, broad and unprecedented central bank measures. Okay, yeah, this is what is important. The pandemic could, however, amplify financial vulnerabilities, including corporate and household debt burdens. So you need to understand, let's understand a bit about how the economy was going before COVID-19. Even before COVID-19, since it had been almost 8 years since the last recession, moderation of growth had already started. Growth was slowing down, and there were already calls that we might head back into a recession. That is why what COVID-19 has done is that it's amplified. For example, if your risk factor was say zero point 0.2, now because of COVID-19 it's increased to say 0.7 or 0.8. So because of this, there's a high risk that if there's no government action, households and corporate debt burdens and their debt default possibilities will heavily increase. Now, the Basel norms, the Basel Committee on, so this is a committee that basically uh, releases the Basel norms on how, the banks, like how much money should the, like for banks to function properly. It has suggested the idea of moratorium. A moratorium is a word that has been thrown around a lot in the Indian news cycles. So what exactly the moratorium is, that your bank allows you to not pay for 3 months, and that payment is deferred. Now, a key thing that I'd like to remind everyone, if anyone is planning on taking a moratorium, is moratoriums are very risky. Why are they risky? That, for example, if I don't pay my loan interest payments for 3 months, they will get added to the principal. So, for example, if say I don't pay 10 rupees in month one, month two, and month three, the 30 rupees that I did not pay and I'm expecting to pay later, that will get added to the principal. What happens when it gets added to the principal? It gets compounded. So instead of me paying 30 rupees, now I'm paying a much higher amount. So therefore, people have been warned that if you can, try and avoid moratoriums, and pay as fast as possible. Swift, bold, and unprecedented policy measures, as I mentioned. This is one more thing that we need to say. Because of these swift, bold, and unprecedented policy measures, the financial market is very optimistic. What they are saying is that since the government and the central bank is willing to do anything, we can rebound. We are optimistic that nothing bad will happen, and so let's start rebounding. And therefore, as you might have noticed, all the stock markets have seen a very heavy increase, and they've been on a heavy bull run. The problem, however, is that the economy is not in a bull run. It's been crashing. People are uncertain. Everything is not decided, and we don't know where the future lies. So this is another feature that has been noted, is the key disconnect between the financial market optimism, that is stock markets and financial markets are saying that everything will be all right, whereas the real economy is worsening and people are very scared over here. And again, limiting market access for some economies, as I mentioned earlier. Due to COVID-19, capital is flowing out of emerging economies. Therefore, they might not get capital if needed. This is where the IMF and World Bank need to step in, and they've already stepped in, and they have assured countries that even if you don't get money, we will give you money. For example, South Africa has taken a loan from the IMF for the first time since the end of apartheid. It is very unprecedented because they always had a stance that we'll never take a loan from IMF. Them taking it signifies how bad the situation has been. Moving on, yes. Now, again, global market. So, what do I mean by leverage? Leverage basically means debt. How much debt does the economy have? So, when I say that global economy is more leveraged now, what I basically mean is that global economy has much higher levels of debt. So this is one projective scenario, that if net government borrowing doubles and there's a 3% contraction, this is the median forecast scenario for 2020, then world's debt will increase from 322% of the GDP to 342. That is, if my GDP is 100 rupees, my debt will increase from 322 rupees to 342 rupees, which is huge. Now, as so, what does this mean? It means that once we get out of COVID-19 and we focus on reviving growth, we need to focus on a reverse bail-in. That is, we need to also focus on reducing our debt levels, because as we have seen in the 70s and 80s, high levels of debt can be very, very punishing for an economy. They can cause lots of problems. So especially for a country like emerging market like India, we need to focus on keeping our debt levels in check, and the RBI until now has done very well under that aspect. So moving on, now let's see what else. Yeah, capital flows. Again, as I mentioned earlier, emerging markets, money starts moving out the moment a crisis starts. As we can see, cumulative capital outflows have been seen, and these outdwarf anything during GFC, the global financial crisis, and the taper tantrum, which was the situation that happened 2030. What does this mean? It means that this situation is bad. If the money going out is so much higher than those situations, it means that that the situation is also that much worse. So any abrupt interruption in capital flows would put EMs at high risk. As I mentioned, EMs, that is emerging market economies like India, Indonesia, South Africa, Brazil, Russia, and Turkey, and more. These are the ones who are at the highest risk. Now, again, global. So this is something that I want to focus on. This is interesting. So the global bond markets are predicted a situation where Europe has a prolonged economic slowdown and the US has a shallow recovery. However, the situation has been the reverse of it. The Europe is seeing a shallow recovery on the back of them controlling COVID-19 very well, and the US, because it could not control COVID-19, is in the face of a prolonged economic slowdown. So it will be interesting to see how the global bond markets proceed now that the situation that they predicted is the reverse of the situation that's happening now. Again, moving on, as I said, in times of crisis you want safe assets that will not fail you, and the US dollar represents the safest asset of all. So therefore a key fear of the global economy is that there will be a dollar shortage. However, due to the swap lines are basically the Federal Reserve telling all the other central banks, we will give you money as long as you give your own currency. For example, Turkey can exchange its lira for dollars with the Federal Reserve. The federal government has set up swap lines and more. So while there is a fear of dollar shortage, I believe that the Federal Reserve, because their governor is one who's willing to do anything to maintain a supply of dollars in the economy, should not be a problem. Moving on, these are all aspects that you can read about, but these are not important. Commodity markets spillovers. Yeah, this is important. So amidst a sharp pullback in demand, this was a feature that is noted few months back. The forward curve for Brent futures is for oil. It changed from backwardation to contagio. That means, so let's examine why this went into negative prices, right? For example, so oil, so the oil companies that are present, they cannot immediately stop production of their oil even if they want to. The reason for that is that if they immediately stop producing oil, the oil wells might permanently shut off and they might not be able to recover the oil well. So even if, and second is that oil production is a lagging indicator. For example, if the oil that I'm getting today would have probably been produced say 20 or 30 days back. So therefore, because of this, the prices fell down. However, uh, now we need to talk. Let's see here. Open interest in Brent options, the calls above $40 strike. Basically, this they're saying that the oil will not go above $40 and below a 20 strike. That means that they expect the oil to remain between $20 to $40 per barrel. Has meant that the market believes that the possibility of such low crude prices will not be possible going forward. If the market believes that such prices cannot be possible, that's a good thing, because earlier the market was very pessimistic. Them being optimistic is a good thing. Now, why has this recovery taken place? The recovery has taken place because OPEC, which is the petroleum exporting countries like Saudi Arabia and all, have agreed to cut down on the production, which is a good thing. They said that we are producing too much, due to which the price is falling, so therefore they cut down on the production. One more thing is that in China and in India, the demand for oil has increased. So since we are one of the heaviest consumers of oil, India and China are consuming oil, and the producers have cut their supply. Because of this, oil prices finally coming back. Now, again, coming to industrial metals, the demand for industrial metals has witnessed severe contraction, which is a bad thing, because unlike oil, it does not go forward or backward that easily as inventory overhang. That is, there being oil has been produced but no one is ready to buy it. That is not there in metals, and metals is a area that will be affected for a very long time. It's a problematic area. So again, moving on to the domestic micro, let's move on to India's macro situation. GDP growth in India has slumped to its lowest level at 4.2%, which is in 2019-20, which is primarily because of the quarter four. So quarter four in India is different from the world. It's not October, November, December. It's actually January, February, March. So quarter four is at 3.1%. That is because January and February managed to stabilize the fall in growth in March. Moving on, recent macroeconomic developments. A key feature is due to COVID-19, both urban and rural segments have been affected. Domestic activity has come to a standstill in April 2020. And one more thing, finally, yes, in August, the demand and economic development has started to increase. But the problem is that it has plateaued now. Like, it's increased a bit and it's plateaued. However, a key thing to note that the level at which it's stabilized now, it's much lower than the initial pre-COVID levels. And again, inflation and any other growth has been primarily driven by agriculture, and agriculture is doing very well. Since India heavily depends on agriculture, that is a good thing. And so the prediction for India recovering is that is contingent upon the support for robust health infrastructure, recovery in demand. Basically, we need to control COVID, and we need to hope that the global economy bounces back. Let's focus on a very another aspect, that is this finances of the government. Indian government always runs in fiscal deficit. Our spendings are very high and our tax revenue is very low. So it is very interesting to note how the government has fared in this situation. Central government's fiscal revenues have been badly hit by COVID-19, because of COVID-19 we've been spending a lot more, right? Because we need hospitals, we need to send stimulus to the economy, so our expenditures have gone up. But because people are not producing, our tax has gone down. So expenditures up, tax revenue down, which means our finances are heavily affected. State governments, on the other hand, are even more vulnerable, because state governments receive on certain major amount of their money from the central government. If that is this, the technical term for that is federal transfers. If federal transfers take a huge hit, states are at a huge risk. For example, the GDP collections for the latest report, usually before COVID-19 it used to be around 1,90,000 crores. However, due to COVID-19, this time it is reduced to only 90,000 crores, which is huge. Again, borrowing has increased. And one good thing is that this is not spilled over to the bond market. The bond market is doing pretty well. Moving forward, current account balance is turned into a small surplus. The reason in quarter four of 2019, because of lower trade deficit and a sharp rise in net invisible receipts. Now, what do we mean by invisible receipts? Invisible receipts means services. For example, the Indian IT sector, that represents an invisible receipt because we are not providing anything solid to them. So so in quarter four, that is January, February, March, the current account balance improved a bit. Moving on, now the exports and imports have collapsed due to COVID-19, which is kind of expected, and the figures are 47.5 and 54.7% respectively. And again, as I mentioned, again, foreign portfolio investment, which is the money flowing in from outside the country, which earlier used to be net inflows, which is that money used to come into India, reversed into net outflows. Again, as I mentioned earlier, this is the same scenario, which is bad. We want money to come into India and not go out. Moving on. Yes, this is a term that you will keep seeing now as we move into financial institutions: risk averse behavior. What does risk averse behavior mean? Risk averse behavior means that you immediately assume that the future is going to be bad. So when you think that the future is going to be bad, there are two things you do. First, you beef up your existing finances. So therefore, banks have started maintaining a lot more money with them, so that if they need it, they can dispense the money. So they started storing a lot more money. The technical term for this is that they have increased their liquidity available to them. Second, since they have become risk averse, they're also giving out a lot less money, which is bad for the economy, right? If the banks are not giving out money which will be used for development and production to take place, it means that the economy is going to be affected. Now let's move on to the corporate sector. How is the corporate sector has performed? Nominal sales and net profits are down by 3.4 and 19.3% again. And why is this? There's another. So obviously them going down is bad for the economy because the economy goes down. Another thing is, if they go down, they're also not paying taxes. The amount of taxes that they're paying also reduces, since government of India already has very a small tax base, that the amount of people who pay tax is very small. The people who are paying, if they start paying lesser tax, that again is a huge problem. So the poor performance has been primarily led by manufacturing companies. As I already mentioned, manufacturing has been heavily hit. However, the good thing is that the IT sector is doing pretty well. And since the services is the future of the Indian economy, there is some level of optimism that we can keep, since they are doing well. Now this is a very important term: deleveraging. What does deleverage? So leveraging means, leveraging is mentioned by the debt to asset ratio, that is the amount of debt you have to as a fraction of the assets that you have. So deleveraging is a good thing, because what does deleveraging mean? Deleveraging means that you're reducing your debt with respect to your assets. Deleveraging is stalled, which is a bad thing, because they're not reducing their debt. And however, the another bigger problem is that the debt that is being taken, it's being taken to not it's being taken to give out loans so that companies can stay afloat, and not towards capital formation. That is, that instead of trying to say improve their company, they're only using that money to keep their companies running, which is a bad thing. And an analysis of this, so non-PSU companies are deleveraged substantially related to public sector. So basically, non-PSU companies are doing better because they have reduced their debt. However, since they are not increasing their growth or operating profit to sales ratio, that is, they are not growing well, it is still a problem. Like their debt is coming down, but their profits are not increasing, which is still a bad thing. And moving on, yes. So again, this is again a problem. So again, coming back to the topic that I mentioned earlier, loan moratoriums, that the RBI has requested the banks to provide loan moratoriums, right? So nearly half of the customers, accounting for around half of the outstanding bank loans, opted to avail the benefit of relief measures. What does this mean? It means that half of the consumers who are given the chance to take the loans have taken the loans. While I hope that the reason why they took it is because they wanted easy credit, the pessimistic scenario would be that the reason they took the loans is because they had no other options. Now let's look at the credit. So when you give out a credit, there's a rating system that follows. The highest is, I think, AAA, followed by AA. Anything about AA and above is very, the AAA I'm not really sure about, sorry, but anything AA and above is good. It means that you're credit worthy. For example, if you're a AA rated or above consumer and I'm giving a loan to you, it means that there's a very high probability that you will give it back to me. And since you are going to give it back to me, the interest that I charge from you will be lower. So in good times, since banks want higher returns, they will also give loans and extend credit to those whose rankings of credit are lesser than AA. But in bad times, they will only give to those who have good credit. So PSB refers to public sector banks, for example, State Bank of India and all. PVB refers to private sector banks. That is, for example, say ICICI, Standard Chartered, etc. So the private sector banks are still registering positive growth, which is a good thing. And PSBs, because there has been, the government is trying to cut down on NPAs and everything. There has been a sharp credit contraction. That is, they have stopped giving loans to anyone who does not have, who reduced giving loans to anyone who does not have a AA and above credit rating. Moving on, just hold on. Oh, 1 second. I'm so sorry for the delay. Yes. Wait. I'm so sorry. Uh, just 1 sec. Page 30. Just one. Give me 1 minute. I'm so sorry for the delay. I'm just, the page has gotten lost. Uh, just 1 minute. I'm so sorry for the delay. Uh, just 1 minute for the delay. So sorry for it, guys. Yes. So, private sector banks have registered positive credit growth, and public sector banks have stopped giving loans because they're worried because of the strict government action. They don't want to give loans to anyone. So even private sector banks have shown high, again, the same word comes again, risk aversion. Even they are showing heightened risk aversion, and they're careful about giving loans. Again, credit flow. Credit flow represents how the money is flowing in the economy. In good times, the credit flow will be very good. In bad times, credit flow will be very low. So again, the major recipient of the credit flow has been the public sector undertakings. For example, say SAIL or any of the government under, because government PSUs are generally thought of to be less risky because the government backs them. If the major recipient is the PSU sector, it's a bad thing, because it means that uh, they're only willing to give it to the safe people. The relative lack of access to credit for borrowers rated A and below during this period is common across both public sector and private sector banks. As I mentioned, the behavior of private banks with respect to credit rating A and below is in particular contrast to the credit growth profile in 2018-19. Look at this table. So basically, in March 2019, even for A and below, credit from private sector banks is growing at 13.35%. That is, they were willing to give it even if your credit rating was bad, but now they've come down to minus 0.56%. That is, credit is going down, which means that they're very, very careful about giving loans. day past due DPD represents how many people who have taken loans are not are have a delay, and day past due or DPD has been on the uptick. Moving on, sector. So we then the report analyzes sectoral allocation of credit. Basically they analyzed where all is credit going, and they realized that people the sectors with lower credit have generally dominated credit growth. So that means that even when the amount of credit going has increased, it's only going to less risky places, which is a bad thing. Where is it going? It has mostly gone to state and central PSUs, which is the government undertakings, and it has also gone to agriculture because agriculture has strong future. This year is expected to be good. Now again, concluding this, top 5 private sector banks have said that they have adequate money. That is, they're not liquidity constrained. The reason they're not giving out loans is not because they don't have money. They have money, but again, the same term, risk averse. They have money, but they're scared to give it out, which means that they're scared about how the economy is going to move forward. Moving on, yes, the composition. So in the financial sector, the composition of the holdings that people have, the standard assets, the largest share is of bonds rated AA and above, which means that again people are still risk averse. And it also means one sec, sorry, yeah, so since a majority of assets are rated A and AA and above, it means that our financial market is increasingly resilient to shocks. That is, even if a shock comes our way, we will be willing to handle, we have the capability to handle it, which means that it's a good thing. However, the stress tests that were taken, notice that even if you're some bonds that were rated AA and above, even they are vulnerable to shocks, and therefore we still need to be careful. Basically they're saying that we have the summary of this is that we have adequate money, but we are scared to give it out. And even when we are giving it out, we should be careful, because even the ones that appear to be safe may not be safe. That is a 3-line summary of the whole financial market situation. And we can skip this because it's not very important. Yeah, special liquidity window for mutual funds to mitigate the effects. So because mutual funds over the last few years have been playing an increasing role, it has become more and more important in the economy because people have been increasing it, and therefore the RBI has taken note of it, and they've extended a special liquidity window for mutual funds. That is, even if a mutual fund is on the verge of a bankruptcy or anything, the RBI has set up a liquidity window so that they can access funds. This shows the proactive nature of RBI, which is a good thing, that the RBI is responding to the crisis as it goes, and they're willing to do anything that it takes. Again, deployment of debt, AUM. AUM means assets under management in government secured. So government securities are again the safer option. So deployment of debt, AUM in government securities as a proportion of total debt has been on an uptrend. That it's increasing. So if your AUM or the assets under your management, that is the total value of money that you're managing, is increasingly in government sector bonds, it means that you don't want to take risks. Again, the trend that has been noted again and again, that people are risk averse. And this is an interesting thing. Volatility in the net asset value of 3 representative schemes shows dislocation of the asset markets induced by drawdown and debt in March 2020. Even daily dividend schemes, which are considered relatively risk free, were impacted by the lockdown. What they're basically saying is that volatility has increased, which is that the risks have increased, and that the even the lowest risk ones, that is the ones that are considered practically risk free, have been impacted by the lockdown. That is, people are scared of putting their money, and they're not putting their money. I know that this I've been repeating the same terms like risk averse and not willing to put their money again and again, but that is a general trend that is being seen in the economy everywhere across sectors, and that is the reason why those terms are being reported. And again, so one thing that we need to note over here is that if in a single investment, a single corporate is investing, it is a bad thing, because if that corporate fails, the whole fund where the place where they've invested will fall down, because a single corporate had invested in them. This is a bad thing. Therefore the RBI, I think, had put out a regulation that restricted it. However, there's still a problem. Imagine that there's a very big fund, and they are investing significant amounts of money in 1, 2, 3, 4, 5, 6. Even though they've limited the share in each of it, since they're investing in every one of them, if they face bankruptcy or if they pull out saying that we don't want to take this risk, significant problems can be caused. So therefore that's a cause for worry. However, since And there's one more thing that large fund size is being preferred now, is that if you're a large fund, there's a higher chance that the government will bail you out, which is why people are preferring large funds over now. So again, yeah, like I mentioned, few corporate houses distributing the surplus, or 4 or 5 fund houses, sorry, few corporates distributing the surplus over 4 or 5 fund houses, and hence exits during times of stress could still be problematic or concerted. That is, even though they restrict themselves in with investing in too much in a single thing, but they invest heavily in five and they pull out of all five, a problem can be caused. That is something that we need to be careful about. Again, NCD or non-convertible debentures, complex terms, we don't need to know what exactly they are for what we are discussing. All we need to see is that CPs or corporate paper, one sec, CP or commercial paper have seen a declining tendency. That means that recent issuance have been dominated by non-financial companies, and financial companies are not giving their issuances. This means that the economy is still very uncertain, and if the economy had been good, they would be issuing. They would have been increasing their issue of commercial paper. Since it's decreasing, it's a problematic area. Moving on to the housing market. So in housing market, demand and liquidity constraints have intensified. That is that. So let's focus on the most important part. So basically a key feature of the, since the problems that have happened in the last 10 years where the construction houses have delayed the position of apartments, consumers nowadays are preferring to buy ready to move homes instead of what do you say, buying homes that are still under construction. Because of that, the adverse effect of the COVID-19 has been the sale of under construction homes, because earlier also it was bad, and now also it has become worse due to COVID-19. The stock of unsold houses have shrank, and there's an inventory overhang. That is, houses are ready, but no one has bought them. The inventory overhang majorly consists of houses that were sold much earlier when they were still under construction. Like I said, under construction projects continue to constitute 70 to 80% of the household inventory. Finally, coming to the systemic risk survey. A systemic risk survey, or a SRS, has been undertaken by the RBI, and they mention this. The major problems, the major risks that they see are global risks. That is, risks caused by other economies. For example, a crash in, say, Europe or US. Risk perceptions on macroeconomic conditions. For example, inflation falling below 4%, or growth falling to negative aspects. These are causes for issue. Other than this, these have been perceived as high. Risk to domestic growth, that is domestic growth falling down, since the government is borrowing heavily and our revenues are falling, fiscal deficit increasing, are very high. That this is a bigger problem for a country like India. Fiscal deficit is a term. So what is fiscal deficit? Basically, a fiscal deficit is a situation where your spending outpaces your earnings. So if you're spending more than you're earning, the difference, that difference is known as the fiscal deficit. So because of COVID-19, it's expected that the fiscal deficit will be increasing, and therefore it has been placed in the high risk category. And again, risks on account of reversal of FII and slowdown in FDI, that is capital outflow, that I already mentioned, that money from money and capital flowing out of India. Corporate sector, sorry, corporate sector vulnerabilities, that is the corporates collapsing. These are all problems that are causing collapsing real estate prices, and increased household savings. So you need to see one thing. We always think that more savings are good, right? However, that's not always the case. If a household is saving most of their money, what does this mean? Two things. One, since they're not investing in the economy because they believe that the money might sink, there is lesser money in the economy. Lesser money in the economy means lesser growth. Second, since they're saving much more, it means that they assume that the tomorrow's market situation is going to be bad. So if there's a heavy increase in savings across the economy, it is usually a very good signal of whether a recession is in place. Similarly, since we are in a recession right now and household savings have increased, that is again so again household savings is a very good indicator of how the market is going. Finally, coming to the end of it, so this is what most of the respondents to the survey think, that there will be a slow recovery post lockdown. That is, even after the lockdown is over, the recovery will be very slow. The lower net interest margins, that is, we will recover, but the profits at so this is for the banks, okay? So the recovery of banks will be slow. Their profit margins will reduce because the interest rates have come down, and elevated asset quality concerns, which basically means that the loans that they've given, there's a higher risk that the loans might default. And finally, the three sectors that will be most heavily that have been most heavily affected by COVID-19 are tourism and hospitality, obviously because of the virus. construction and real estate, because they need heavy amounts of capital to be invested, and no one is willing to invest that heavy amount of money because houses are very expensive and people don't want to invest in expensive things right now. And aviation, again, just like travel and tourism has collapsed, aviation has collapsed. The prospects of a recovery in the next 6 months are bleak. And so this is again, as been mentioned, that the growth recovery seems to be very bleak, and higher emphasis on localization. This is not the key focus of this paper, but what this basically means is that going forward, because of the increased tensions between the economy, for example, China, India are are not on speaking terms right now. US and China have been through a trade war and it's still risky right now. For example, TikTok was banned by India. TikTok and other apps were banned by India. US is considering banning a lot of them. So therefore, higher emphasis will be given on localization as we move. So basically, this represents a shift. Until now, globalization is used to be the trend. Now, greater focus will be given on localization. Finally, summarizing all that we've seen, what does this basically mean? Unprecedented certainty, word that we've seen again and again. Financial market have finally stabilized because of unprecedented fiscal and monetary stimulus. That is, the governments and central banks have responded very well. They've done everything that they can, and that has helped prevent the situation from being more worse than it already is. And bank, again, risk aversion, that is, bank credit is present but they're not willing to lend it out. Capital flows that initially flew out of India, that the money went out very fast in the first quarter, is slowly coming back, but even then it's very, very less, and therefore it's still a problem. And adequate levels, so this is a good thing. The RBI has heavy amounts of foreign exchange reserves. For example, we recently conducted a swap and we provided dollars to Sri Lanka because they had a shortage of dollars. So this represents a good thing on part of the RBI, because they have maintained heavy exchange reserves. So finally, concluding this unprecedented scenario, government and the central bank have responded very well, but even then everything is very, very uncertain, and it remains to be seen how we go forward. Moving forward, I'd like to move on and shift to Vishwas will be taking over the presentation for the second part of it. Thank you for bearing with me, and I'm really sorry if I spoke for too long.
Okay, so thank you, Kudligi, and like I would ask you to open the PPT now. If you could share the PPT.
Is it visible now? Financial institution soundness and resilience.
Yeah, yeah. So that was like a really great overview about the first chapter, Kudligi. And now I'll be taking the second chapter, the financial institutions and soundness, their soundness and resilience. So Kudligi, next PPT. So basically, in this portion, what I'm going to be talking about are the performance of various types of banks during the financial year 2019-20. So the first type of bank that we are going to look at is the scheduled commercial bank. So first of all, since like I don't really have a economics background, so I learned it a lot on my own. So I'm going to make it digestible for you guys also, so that you can learn. If you don't even have any prior economics background, I'll be telling about each and every term, breaking them into short portions and talking about their implications, whether like growth of something is good or growth of something is bad. So yeah, it's going to be quite bite size. So let's talk about scheduled commercial bank. So what are scheduled commercial banks? Scheduled commercial banks are those banks which are included in the second schedule of RBI Act 1934. They carry out normal business of banking, such as like accepting deposits, giving out loans, and others like banking services. So the major difference between scheduled commercial banks and scheduled cooperative banks are their holding patterns. Since cooperatives are registered under the Cooperative Societies Act as cooperative credit institutions. I'll be talking about cooperative banks later in this PPT. So yeah, uh, we'll talk about scheduled cooperative banks then. The banks included in the scheduled list, the RBI Act list should basically fulfill these two conditions. The paid capital and collected funds of the bank should not be less than rupees 5 lakh, and any activity of the bank will not adversely affect the interest of depositors. Also, scheduled banks enjoy some facilities, the most important being scheduled banks become eligible for debts and loans on the bank rate from the RBI. Now I'll be talking about what was the performance of these scheduled commercial banks. Uh, the credit growth. So what is credit growth basically? The credit growth is basically increase in loans for the private sectors, individuals or public organizations. So basically what happens when the credit is increasing? Consumers can borrow and spend more, and businesses can invest, like borrow and invest more. So the credit growth of the scheduled commercialized banks year over year, YOY, which was already very weak in the first half of the financial year 2019-20, it slid further down to 5.9% with no recovery till June. So what does this basically mean? This means that the credit growth, the implication was the credit growth uh, basically is not increasing. So what I said that like consumers cannot borrow and spend more, businesses cannot borrow and invest more. So that was the major implication of the credit growth not increasing. The next thing that we'll be looking into is the profitability ratio. Uh, the next thing we'll be looking into is the profitability ratio. That is return on assets and return on equity. So what happened during the profitability ratio, like during the financial year 2019-20, they declined in the second half of the financial year 2019-20 across all bank groups. Like scheduled banks, they contain majorly five banks, portions among them, like Kudligi talked about, private sector banks, public sector banks, foreign banks, and some other banks. So uh, this happened. The profitability ratio, basically what is the meaning of profitability ratio? Profitability ratio is nothing but like the profitability compared to the last financial year basically. So that is what they talk about in the profitability ratio, that basically the profits fell, the return on assets it was low, the return on equity it was also low. Now we'll be talking about the GNPA, the gross non-performing assets. So for this, I'll first like to introduce the term NPA. Like most of the people must of you guys must be knowing this, but some of you may not. So I'll be explaining NPA too. So what do you mean by NPA? NPA are the non-performing assets. Some guys also like to term this as call this as bad loans. So non-performing asset is classified when the loans or advances, they are in default or in arrears. In default meaning that the person is not able to pay back, or in arrears mean like for a fixed amount of time he hasn't paid back. NPAs plays like a financial burden on the lender. A significant number of NPAs over a time may indicate to regulators that the financial health of the like country and the system is in jeopardy. So what happened in the gross non-performing asset ratio across all scheduled commercialized banks is that they had reached 9.3% in September 29, but they have come down to 8.5% since then. So what is the meaning like of this? The implication is basically that the lower the ratio is, it is the good for bank, as it reflects that more loans are standard assets. Standard assets meaning that they can be recovered on time. So basically, as low a GNPA is, that is better for the banks. So that is basically what GNPA means. Now we'll be talking about like quality of banks sectorally. Sectorally, the quality of banks to service sector worsened in March 2020. The GNPA ratios in this sector they surged, which means that basically NPAs, the gross NPAs, they basically increased. So that is not good for the bank. So the service sectors worsened in this regard. Whereas the infrastructure sector and the basic metal sector, the GNPA ratios came down in these sectors. So that means that these sectors in this regard are performing much better than the services sector. We'll be talking about large borrowers also now. Large borrowers accounted for 78.3% of aggregate loan portfolio, 51.3% of the aggregate loan portfolio, and 78.3% of GNPS respectively from SCBs in March 2020. Both these shares have declined since March 2018, implying that basically the credit and the NPA aggressions are occurring in the small borrower category. So basically, what is a large borrower? A large borrower is defined as one who has aggregate fund based and non fund based exposure of 5 crore and above. So basically, what does this mean? That the ratio has come down. That the large borrowers, they are not being the NPA anymore, like and the small borrowers, like they are defaulting on their credit. So that is what is happening. That is what this signifies. The banking stability indicator. So now this is something very interesting. So the banking stability indicator is basically it is an indicator. It considers 5 dimensions for assessing the changes in the underlying conditions and the risk factors. So the 5 dimensions are soundness, liquidity, efficiency, and quality and profitability. So here for the financial year 2019-20, we have sort of a mixed response. SCBs have recorded deterioration in soundness, liquidity, and efficiency in March 2020 as compared to September 2019 position, whereas asset quality and profitability showed marginal improvement. So basically, in 3 regards, the stability indicator showed that we have deteriorated, whereas in asset quality and profitability, we have shown a marginal improvement. But this marginal improvement isn't a thing to be happy about, basically, because no comfort can be drawn from this fact, because any loss of income from the banks during this COVID-19 thing, it will only be visible in the first quarter of 2020-21. Basically, whatever loss that they are suffering right now, we cannot see it. We'll be able to see it when the next report comes out. So it doesn't really matter that there was a marginal improvement in quality and profitability, because the banks, like as we know, they are in losses. So this would basically be shown in the next report. So now I'll touch about something which Kudligi also talked about a bit in his portion, the macro stress tests. So the macro stress tests they basically attempt to analyze the impact of cumulative shocks. So shocks are basically anything that like COVID-19 was an unprecedented shock. So something which is going to hit the financial institutions of a country. So those are like shocks. So macro stress tests, what they basically do, they analyze the impact of such shocks. So like Kudligi already talked about that the baseline scenario is like 8.7%, and after that it may increase from 8.5% to 12.5% by March 2021 under the baseline scenario. And the macroeconomic environment, if it further worsens, the ratio may escalate to 14.7% under very severe stress. So these macro stress tests, they have 3 condition conditions. So the first is the medium severe adverse scenario, the medium adverse scenario, the severe adverse scenario, and a very severe adverse scenario. So the medium adverse scenario is basically the baseline scenario. The severe adverse scenario is basically multiplying the already existing variables by increasing basically their value by 0.25. The severe scenario is increasing their the variables, the shocks, from 1.25 to 2 SD, whereas the very severe adverse scenarios are those in which the variables, they are increased from 2.25 to 3 SD shocks. So this is what happens. But let us talk further about in this regard, because the percentages which RBI is talking about, they might not be the expected ones, and the situation can be much worse than the RBI is portraying it to be, because it has done so in the previous reports as well. Like it's Hello, Kudligi? Yeah, so I was still on the previous side, like the scheduled portion only. The previous one. Yeah. So the macro stress tests. So previously, between 31st March 2014 and 31st March 2018, there was a lot of bad loans being like reported, and the health of the financial system, that wasn't really well. In that time, the actual bad loans rate turned out to be much more than RBI's forecast, even in the like very severe scenario. Like in March 2015, RBI was forecasting that even under the severe stress scenario, the bad loans, the NPAs, would at most reach 4.5 trillion rupees. Whereas by March 29, the total NPAs had stood at 10.36 trillion rupees. So basically, economy could be in a very worse condition than RBI is like portraying it out to be, and that is usually the case. So now we'll talk about that. Why doesn't basically RBI tell us the real numbers, sort of? So if the RBI would have gotten out and said that the NPAs, the total NPAs, they'll stand at 10.36 trillion. So that would have scared all the financial institutions like in the country, and that would have been basically a very bad economic scenario. Uh, so what they did was they increased it from year on year basis. So basically what they did was let's say in year 2014 they said that the NPAs would be somewhere around 3 to 4 trillion. Then in 2015 they increased it by 1 trillion. In 2016 they increased it by another 1 trillion. So like this they basically changed their forecast yearly, so that as to not give a massive shock to the financial system. So that is why RBI basically does that. So that was one interesting thing that I found. And the system level CRAR. So what is CRAR? CRAR is capital to risk assets ratio. So capital to risk asset ratio, it is also known as capital adequacy ratio. So the system level CRAR, it is projected to drop from 14.6% in March 2020 to 13.3% in March 2021 under the baseline scenario, and to 11.8% under the very severe scenario. So basically, higher CRAR means that a bank is better capitalized. What is the meaning of a bank being better capitalized? Capitalized means that delaying full recognition of the expense. Basically, let's say uh, the firm of bank or a firm or something of an institution, like, because this capitalization thing, it applies to not only the financial sector but the companies too. So like delaying that, it is a way so that the a bank, they can show that that like we are capitalized, so the profits, they are not reducing in this year, and the basically they it is that in simpler words, it is this tendency to uh, how to put it, uh, the so I'm a bit stuck here. So basically what it meant was that the reduce the losses, you basically spread it over a larger period of time. Yeah. So either, so let's say that instead of reporting that you have like the profits have been so less, if a bank is better capitalized, it can carry forward that to the next year, and basically say that that the profits haven't been so low, and like so it's basically the how spread over the financial system can be. So the next slide. So now we'll be talking about the scheduled urban cooperative banks. So a bank which is established to provide banking services to individuals and businesses, that is called a commercial bank. While a cooperative bank is a bank that provides financing to agro and rural industries. Um, scheduled cooperative banks, they also consist of two like sectors: scheduled state cooperative banks and scheduled urban cooperative banks. In this report, RBI has talked about scheduled urban cooperative banks, and that is the portion that I'll be covering too. So the performance of the scheduled urban cooperative banks, it broadly remained stable between September 2019 and March 2020. This can be attributed to the fact that basically both these banks, like the scheduled commercial bank and the scheduled cooperative banks, they target different things. Well, the scheduled commercial banks, as like the name suggests, it's a commercial bank, so it targets profitability, whereas scheduled urban cooperative banks, it is a cooperative. So, and that too for like agro and rural industry based things. So it targets different thing like community welfare and like financial security of all the like stakeholders involved. So that is why the scheduled urban cooperative banks, they did not suffer as much as the scheduled commercial banks. So they remained quite stable between September 2019 to March 2020. The CRAR of these urban cooperative banks remained at 9.8% for both the quarters, no change. And their GNPAs, they declined for 10.5% of gross loans and advances to 9.9%. This is a good thing because the lesser the GPA, the better the standard assets, and that is the better for the bank. The provision coverage ratio, that increased from 40.9% to 61.4% over this period. Now, what is provision coverage ratio? In banking terms, provisioning means to set aside or provide some funds to cover up losses if things go wrong and some of their loans turn into bad assets. Provisioning coverage ratio refers to the prescribed percentage of funds to be set aside by the banks for covering the prospective losses due to bad loans or NPS. So basically, the increase of the provision coverage ratios is a good thing because now the banks, these are better secured in terms of the loss due to NPS. So this was it for the scheduled urban cooperative banks. Now we'll be going out to the next side, the non-banking financial companies. So what are non-banking financial companies? Non-banking financial companies, NBFCs, are basically financial institutions that offer various banking services, but they do not have a banking license. So that is basically what is the definition of the NBFCs. Although the size of NBFCs compared to these scheduled banks, it is like very less. Like on the balance sheet size, it is 1/5 of the SCBs. The importance of the former, like these NBFCs, lies in the fact that the last mile credit delivery and the niche segment support in the Indian financial system, that is provided by the non-banking financial companies. So now I use a lot of jargon again, so I'll be explaining that. What is the meaning of last mile credit delivery? So last mile is an operations term. It means basically that it is used to describe the short geographical segment of delivery of communication. So and media services to customers located in dense area. Basically, uh, the last part of the operation, like let me break it down to you. Let's say like all of us would have like ordered something from e-commerce websites, let's say Amazon. So you can trace your orders. So the last part, like when the portion has reached to your respective cities and you get a message that the person is out for delivery, so that can be talked about as a last mile thing. So last mile, what do you mean by last mile credit delivery? Basically, non-banking financial companies, they are much more approachable for like most of the Indian population. So that is what they meant by last mile credit delivery, the importance of last mile credit delivery for non-banking financial companies. And some of the NBFCs, they focus on very niche areas. So that is also important for a healthy growth of Indian financial system. So what happened in the NBFCs? The GNPA ratio of the NBFC sector, it declined during successive quarters in December 29. However, it surged in the March 2020 quarter. So basically, what happened was that, like, it showed promise, this NBFC sector, that the in with regards to the GNPA, it is on a decline, and the asset quality, it is basically increasing. But in the light of this lockdown and this whole COVID-19 thing, the sector again, it reported an increase in the GNPA ratio. The CRAR of the sector stood at 19.6% in March 2020. So, which is lower than a level that it was uh, ago. So that means that the CAR being less is a bad thing, because that means that the institution isn't uh, better capitalized. It is not as capitalized as it was last year. Also, there has been a decline in market funding of NBFCs during COVID. So that is a really important thing to worry about, because the declining share of market funding, it basically has the potential to accentuate liquidity risks for NBFCs as well as for the whole financial systems. So small size, mid size, and like AA or lower rated NBFCs, they have been shunned by both banks and markets, basically, which are accentuating the liquidity tensions faced by the NBFCs. So now I talked about liquidity risks here. So I'll be explaining the term liquidity. Liquidity is the ability of a firm or a company or even an individual to pay its debt without suffering catastrophic losses. Conversely, liquidity risk stems from the lack of marketability of an investment that cannot be bought or sold quickly enough to prevent or minimize a loss. Now, basically, stress tests for the NBFC sectors, uh, they were on the same line as the scheduled commercial banks, and uh, they showed the similar pattern. So there is nothing to talk about here. So now to the next slide. So now we'll be talking about the network of the financial system. So this might be perhaps the most, let's say, logical slide in this regard, that there aren't many banking lexicons to be understood. And basically, it talks about that how a financial system works like in a network, and like what is its structure. So a financial system, it can be visualized as a network with financial institutions as nodes and bilateral exposures as links joining these nodes. So basically, what do we mean by this regard is that there is a lot of interdependence between all the banks, all the NBFCs, all these like urban cooperative banks, commercialized banks, and they are independent on each other. They are dependent on each other. Sorry. So that is what it talks about, that financial institutions have nodes and bilateral exposures, like basically the exposures that they each other the each of the banks or the sectors has with the other, that can be considered as a link. So while these links enable efficiency gains and this diversification, they can also become the conduits of risk transmission in cases of crisis like we are suffering right now. So basically, what they are trying to tell is that all these financial institutions, they are sort of connected with each other, and through the links, and that is a good thing, because when some sector, like one of the sectors is booming or the economy is booming, all the sectors, they can, like they have dependence on each other, so they can uh, benefit from each other. But in the cases of shocks, like this COVID-19 thing was an unprecedented shock, since one sector is suffering, so all the sectors, they'll suffer sort of together. Basically, it will be transferring, like let's say the commercial banks, those are suffering, so the suffering, it will be transferred to the NBFCs in a, like, some period. So that is what they mean, that the all the financial systems, a network. It is a network, and they are interconnected. And was also a model which talked about the similarity of pandemics to financial crisis. So, like the pandemic transmission is a probabilistic transmission. A healthy person coming in contact with an infected one will catch the infection with a certain probability. So that can be also said about the transfer of financial basically health from one sector to the other sector. Such probabilistic conditions imply that basically the financial in the financial sense, there's like uh, it, uh, it might be a case that like since it is a probabilistic approach, that the commercial banks, they don't really affect the NBFCs. That can happen due to a probabilistic approach, like it happens in pandemic. Like let's say a guy which was like uh, not like which did not have the COVID case, he came into a person which had like COVID-19. So there's a certain probability involved that this person would also catch COVID-19. So that is what the similarity the model was trying to relate to. That basically there is a probability that each of the sectors can affect the other sectors. It may or may not happen according to the probability, but that is what the model was basically talking about. It also like in this segment there was also a lot talked about interbank market. So the interbank market, as the name suggests, it is the market between all the banks. The size of the interbank market has been persistently declining over the last few years. So private sector banks, they remain the dominant players in the interbank market, followed by the private sector banks and the foreign banks. As at the end in March 2020, the interbank market typically has a core periphery network structure. So uh, how many of you guys know about like P2P structure? So when a lot of P2P structures are they are like combined together, peer-to-peer structures, it basically sort of creates a core periphery uh, network structure. So that is how interbank market is portrayed in this report. And the last thing which the report stressed upon was that the size of the interbank market has continued to shrink along with the better capitalizations of the public sector banks, which has basically led to a reduction in the exposure that could be a result from a hypothetical failure of a bank, NBFC, or HFCs, and or due to any other macroeconomic distress. The banking system, it may need to augment its capital to cater to a post-COVID-19 revival in the economy, since a shrinking since a shrinking interbank market along with the higher capitalization have moderated the interbank contagion risks for now. But post COVID-19, basically the capital to cater the whole economy, it has to be moderated in some way or another, because the public sector banks, they are better capitalized right now. So the contagion chances are very low in the interbank markets. But basically that was the last thing that the report talked about. Now I'll be handing it over to Anjaney.
Yeah, thank you, Vishwas. So I'll be talking about the regulative initiatives in the financial sector that's been carried out, especially with regards to after after the COVID situation struck us. So let's get right down to it. During the first quarter of 2020, the prices of risk assets collapsed and the market volatility, it spiked, which Kudligi has already talked about for quite a long time. Now, given the unprecedented nature of the crisis, central banks have been called to the front line again and have mobilized an unprecedented defense involving both conventional and unconventional instruments: interest rate reduction, funding liquidity, and market liquidity expansion. asset purchases, credit easing, macro-prudential policies, all the big words there, to keep the financial markets and financial intermediaries functional and to preserve global financial stability. Now, as COVID-19 exploded into a pandemic, central banks' first line of defense was to reduce policy interest rates in order to ease borrowing costs and financial stress. That's staple monetary policy. You reduce the policy interest rates, so loans can be taken at at a more lenient interest rate. Right. Now, the central banks are also provided forward guidance on the future path of policy rates, indicating a highly accommodative policy stance going forward. Now, while the report explicates on what the other central banks around the world have done in response to the prevailing crisis, I shall limit myself to the confines of India only because of the time constraints we are bound by today. There is a lot to grasp, and I hope you have pen and pencil at the ready. Now, as for domestic developments, it is noted that the decisive monetary and fiscal policy actions have stabilized investor sentiment in the short run. But there is a need for the government and all regulators to keep a continuous vigil on the financial vulnerabilities, even as efforts are focused on avoiding dislocation in financial markets. Now, Kudligi has talked about this a lot in his section. I'll talk about the initiatives from the regulators here. The government of India has, on its part, worked out a support package entailing a prudent mix of sovereign guarantee-based schemes, direct fiscal expenditure, and longer-term structural policy reforms. The package encompasses a comprehensive Atmanirbhar package in 5 tranches, covering measures to create rural employment, infrastructure, support to MSME sector, and creation of an enabling business environment. Other measures include expenditure control, such as freeze on employees' dearness allowance, as well as a relief package to support the vulnerable and disadvantaged sections of the society, both in kind, such as free supply of grains, for example, both in kind, and in cash, such as the direct benefit transfer. Put together, the overall package, including from the RBI in forms of various liquidity measures, is in the order of 10% of GDP. Furthermore, borrowing limits of the state governments were increased from 3% to 5% of gross state domestic product. Let me talk a bit about the major elements of the Government of India's policy package here, as you can see on the slide. One, a fund of funds. A fund of funds is a pooled investment fund that invests in other types of funds. I would suggest for the reading out this, it's a very interesting concept. Now, the first major element of the Government of India's policy package is a fund of funds for infusing equity into micro, small, and medium enterprises, the MSMEs, as I think has already been talked about. The fund of funds, collateral-free loans for standard MSMEs, provision of subordinate debt to those MSMEs which are classified as stressed or MPA. Now, the second major element, employee provident funds support to eligible establishments by means of payment of employer and employee EPF contributions till August 2020. Now, employee provident funds are, they're basically, I'll explain this in a while. Let me go on to the next major element of the Government of India's policy package. Special liquidity scheme for NBFCs, HFCs, and MFIs, or which are micro finance institutions, and HFCs, which are housing finance corporations. So special liquidity scheme for NBFCs, HFCs, MFIs, and partial credit guarantee schemes 2.0 for NBFCs, HFIs, and MFIs to inject liquidity. There has also been tax deducted at source and tax collected at source. These have been reduced by 25% of the existing rates for the remaining period of 2020-2021. Additional refinance support for crop loan requirements of rural cooperative banks and through the National Bank for Agricultural and Rural Development, or NABARD, which have been talked about in the news quite recently. Concessional credit via Kisan Credit Card or PM Kisan beneficiaries, animal husbandry and fisher dependent persons to inject additional liquidity. Now, concessional loans are loans that are extended on terms substantially more generous than market loans. The concessionality is achieved through either rates below those available in the market or by extensions of grace periods or a combination of these. The concessional loans typically have long grace periods. Now, another major element, interest subvention of 2% on mudra shishuloni, that is the interest is paid for by the government of 2%. There has also been a proposal for a scheme to facilitate easy access to credit for street vendors to restart their businesses. Now, on to payment and settlement systems. The Reserve Bank of India payment system vision for 2020 aspires to ensure efficient and uninterrupted availability of safe, secure, and accessible and affordable payment systems. In pursuance of this vision, the RBI made available in December 2019, if I'm not wrong, the National Electronics Fund Transfer, the NEFT system for round-the-clock fund transfer facility. Now that's big because India has joined a select group of nations which offer round-the-clock fund transfer facility. The others being Hong Kong, United Kingdom, South Korea, Singapore, China, and so on. The payment system vision of 2019-2021, which I just talked about, of the RBI, envisaged a creation of a Acceptance Development Fund, now termed as Payments Infrastructure Development Fund, or the PIDF, to subsidize deployment of point-of-sale acceptance infrastructure. The examples of point-of-sale infrastructure, point-of-sale acceptance infrastructure may be those card readers which you're so familiar with, where you insert your card and you get the receipt right away in supermarkets whenever you need to make payment. Now, the RBI has made an initial contribution of 250 crores to the corpus of PIDF, covering half the fund, and the remaining contribution will be in form of card issuing banks and card networks operating in the country. The PIDF will be governed through an advisory council and managed and administered by the RBI. Could we have the next slide, please? Thank you, Kudligi. Now, resolution and recovery. Now, before I get started with this, let me elaborate on what is an CIRP or the SIRP. Now, a CIRP is an abbreviation for Corporate Insolvency Resolution Process. It's a recovery mechanism for creditors, as in when a certain credit agreement goes bust, or it isn't the borrower it defaults on their credit payments, sort of. If a corporate becomes insolvent, a financial creditor, an operational creditor, or the corporate entity itself may initiate this CIRP. Now, since the coming into force of the provisions of the corporate insolvency resolution process, with effect from December the 1st, 2016, close to 3,800 CIRPs had commenced by the end of March 2020, which is a big number. It's a good number. Now, on to the non-banking financial companies. Vishwas has already talked about this a lot, so I will be touching on very briefly on this topic. The report noted that NBFCs complement banks in extending credit in the economy, and they're a vital cog in the wheel for extending last-mile credit needs. As on March 31st, 2019, the total assets of NBFCs and HFCs was 44.4 lakh crore, which is approximately 1/4 the size of the assets of scheduled commercial banks, which are 166 crores. Now, mutual funds. The mutual fund industry's assets under management fell by 9.2% at the end of March 2020 over its value at the end of September 2019. Now, the assets under management, the title itself is pretty self-explanatory. Kudligi has already talked about it before. The industry's assets under management are basically the value of the amount of assets under the industry itself. The mutual industry's assets under management fell by 9.2% at the end of March 2020 over its value at the end of September 2019, with assets under management of the equity-oriented schemes declining more than their debt counterparts. Now, equity and debt, they're different. Equity is basically the shares or the stocks. Their shares or stocks are examples of equity, whereas debt counterparts would be bonds or commercial paper. It is important to realize, and the report noted this too, that while investments in corporate bonds offer higher returns, the risk premium may not be commensurate with the current elevated risk in the corporate bonds market owing to the COVID-19 pandemic. There's uncertainty in the market. So the risk premium offered by these corporate bonds, they may not be commensurate. The exposure of debt-oriented mutual fund schemes that now debt-oriented mutual fund schemes are schemes that invest in debt-oriented securities such as bonds, commercial papers, debentures, etc. The exposure of debt-oriented mutual fund schemes to corporate bonds rose to 46.9% of the total assets under management of these schemes at the end of March 2020. From 42.9% at the end of September 2019. The exposure of debt-oriented mutual funds to corporate bonds, which have been downgraded, exhibited a steady downward movement, as is to be expected in the last 6 months. The exposure was 2.37% at the end of September 2019, which came down to 0.61% in March 2020. This is quite intuitive because obviously you wouldn't want to invest in a security that's been downgraded. Mutual funds total deployment in the equity market in March 2020, noted the report, was around the range of 8.92 lakh crore. This was sizably lower than in October 2019, owing to reduction in the value of equities in the wake of the extreme uncertainty surrounding COVID-19. However, market conditions and sentiment improved in April 2020, and the equity markets recovered. The total deployment in the equity market increasing in value to 10.14 lakh crores. Could we have the next slide, please? Thank you, Kudligi. Capital mobilization. Now, the total capital raised in the primary markets during the 2019-2020 rose by 11% year on year, with 3.35 lakh crore raised through both equity and debt issues during January-March 2020, despite volatile market conditions. Now, equity and debt issues, they're pretty self-explanatory. Whenever a company wants to raise money, they issue their equity. That is, they give their shares or their stocks out in return for money. Debt issues are similar, but they follow a different. Whenever they want to raise money, they issue instruments like what I want to talk about, commercial papers, bonds, etc. You don't own a share in the company per se, but you have lended to it, and the company is bound to give you back a certain percentage of the amount you have lended along with the principal. So that's on debt and equity issues. Now, within the total funds raised in capital markets during the financial year 2019-2020, the amount raised through equity issues through shares increased by 29.2%, mainly due to higher amount raised through public issues. Public issues are when shares are allowed for the public to buy, as in the company. It's done through ways like initial public offering, for example, wherein the public are encouraged to invest in their shares, bid up their shares and buy a stake in the company. Now, increased by 29%, mainly due to higher amount raised through public issues and through right issues. Now, a right issue is an invitation to existing shareholders of the company to purchase additional new shares in the company. And qualified institutional placements. Now, let me take a bit of time to explain what that is. A qualified institutional placement, or a QIP, is at its core a way for listed companies to raise capital without having to submit legal paperwork to market regulators. Of course, they must meet some criteria as prescribed by the Securities and Exchange Board of India, the SCBI. So yeah, within the amount raised through equity issues increased by 29.2% due to increased amounts raised through public issues, right issues, and qualified institutional placements. Whereas the capital mobilized through debt issues went up by only 7%. During the year, 14.98 14,984 crore was raised through public issues in the bonds market. 6.75 lakh crore was raised through private placements of corporate bonds. Now, a private placement is a sale of stock shares or bonds to pre-selected investors and institutions rather than on the open market. Now, if it was on the open market, that would be a public issue, which I've already talked about. The major issuers were body corporates and NBFCs, accounting for nearly 55% of the total issuances during the year. The commodity derivatives market. Now, the report stated that the COVID-19 is expected to drive down commodity prices in 2020, with the energy prices being the most impacted so far. Crude oil prices have already touched a historic low in April 2020, with April crude oil futures settling at negative levels one day before the expiry. Yeah, so the global base metal prices have also fallen, albeit by a lesser magnitude than the oil prices, mind you, pulled down by the prolonged slump in global manufacturing demand. Now, Kudligi has already talked about this before. The slowdown in economic activity, particularly in China, and shutting down of mines and refineries across the world disrupted metal supply chains in the first quarter of 2020. Global uncertainties and safe haven flows drove gold prices higher in 2020, with some correction in March. Commodity prices are expected to trade softer. Now, trade softer would imply that there are more potential sellers in the market rather than buyers. So commodity prices are expected to trade softer in 2020 than in 2019. The outlook will depend on the effective containment of the pandemic, say, and the relaxation of social distancing measures. Now, during 2019-2020, the benchmark commodity derivative indices fell sharply. The MCX ICOMDEX composite index. Now, this is a benchmark benchmark that tracks the commodity derivatives, right? The MCX ICOMDEX composite index declined by a 22.9%. The ICOMDEX crude oil and ICOMDEX base metal indices declined by 63.3% and 16.0%. This is not a good sign. At NCDEX, which the NCDEX is a leading exchange in agriculture derivatives. What the Sensex is for corporates, NCDEX is for agricultural derivatives. Now, at the NCDEX, however, the average daily turnover witnessed a fall from. Let me explain what a turnover is. In the case of investment markets, a turnover is the value of the securities bought or sold on the exchange, right? So the average daily turnover of NCDEX witnessed a fall from 1,488 crore before March to 682 crore in the period post-March 2020. MCX, which is a leading exchange in the non-agricultural commodity derivatives, also saw a similar magnitude of decline in turnover by around 55%. I'm sorry for the delay. Yeah, insurance. The COVID-19 situation's impact on the insurance sector may take the form of a potential increase in life and health insurance claims, the report noted. Concerns about solvency of insurers due to market volatility, asset liability mismatches, and depressed premium collections and revenues may also hit the insurance industry. A prudent regulatory framework, greater supervisory oversight of investments through conservative investment policies, and asset valuation methods in the Indian insurance sector limited some of those downside risks. These are victories of policy. Pension funds. Sorry, the national pension system let me begin by defining what the MPS is. The National Pension System is a voluntary defined contribution retirement savings scheme designed to enable subscribers to make optimum decisions regarding their future through systemic savings during their working lives. The corpus accumulated during the working life is utilized for old age income of the NPS subscribers. In response to COVID-19, the PFRDA, or the Pension Fund Regulatory and Development Authority, took several steps for supporting subscribers and intermediaries. The authority included as COVID-19 among the critical illnesses eligible for partial withdrawals under the NPS. Now, the Atal Pension Yojana is a defined benefit voluntary pension scheme with subscribers mostly belonging to the unorganized sections of the society, suffering the most during the lockdown and post-lockdown periods. Under the APY scheme, subscribers have to contribute to their pension accounts on a monthly, quarterly, or semi-annual basis through an auto debit facility from their saving bank accounts. That is, the money from their saving bank accounts are automatically debited to the Atal Pension Yojana scheme. The authority took cognizance of the difficulty for subscribers to contribute regularly to the scheme during COVID-19. Hence, it was decided to stop auto debits from saving accounts for APY contributions till June 30, 2020. That is, the money won't be taken automatically from their saving bank accounts. As for development updates, the National Pension Scheme and the Atal Pension Scheme have shown significant progress in terms of the total number of subscribers as well as assets under management. The number of subscribers in NPS and APY have reached 1.35 crores and 2.11 crores respectively. Assets under management under NPS and APY have also touched 4 lakh crores and 10,000 crores respectively. Now, let me talk a bit about, could we have the next slide, please? Yeah, let me talk about a bit about the regulatory measures that have been undertaken. Just give me a second here. Yes. So let's talk about the Reserve Bank of India first. Now, the Reserve Bank of India conducted targeted long-term repo operations. Now, what are targeted long-term repo operations? Let me introduce the long-term repo operations first, because the concept of TLTRO, or the targeted long-term repo operations, is connected to the LTRO. Now, the long-term repo operations, or the LTRO, is a tool which allows banks to borrow funds from the Reserve Bank of India for a tenure up to 1 year to 3 years at the policy repo rate against government securities with similar or higher tenure as collateral. As in, the banks will have to deposit with the RBI government securities as collateral and receive the money. Now, why is this important, you may ask? Doesn't this happen every day? Now, the problem is the long-term repo, the fact is, I'm sorry, there's no problem here. The long-term repo operations are different from the normal repo operations that are conducted by the RBI. The normal repo operations conducted by the RBI are usually short-term loans that are given for overnight spending, let's say. They're very short-term loans. The long-term repo operations allows for the banks to keep with them the money that they've borrowed from the RBI for a longer time, for 1 year or 2 years. This also helps in the cascading effect of the repo rate, as in, whenever the repo rate is reduced, banks are also supposed, the repo rate is the rate at which banks borrow from the RBI, right? Whenever banks borrow from the RBI, they have to give a set interest back to them. So whenever this repo rate is low, the borrowing costs for the banks are low. So hence, they are also able to give their customers loans at lower borrowing costs. With short-term repo operations, this isn't exactly possible, because the amount that is borrowed, it's only kept with them for a very short amount of time. But with the LTRO, now the banks have a opportunity to extend the benefits that they get from the long-term repo rate to the customers, which impacts the common man whenever they try to borrow money from the bank. So that's a brief primer on what the repo rate is, what the LTRO is. I hope you guys understood that. So yeah, so the LTRO, I'll explain once more, is a tool which allows banks to borrow funds from the Reserve Bank of India for a tenure up to 1 to 3 years at the policy repo rate. The targeted LTRO, it is the same as LTRO with a difference that the money borrowed by the banks under this scheme has to be deployed in investment grade corporate bonds, commercial papers, or non-convertible debentures. It means that this LTRO must be targeted towards investment grade corporate bonds, commercial paper, and non-convertible debentures. Hence the name targeted LTRO. That's a brief primer. Let me get back to explaining what the measure was. The targeted long-term repo operations are RBI conducted long-term repo auctions of 3-year tenor for amount of 1 lakh crore for investing in corporate bonds, commercial papers, and non-convertible debentures with concession in MTM guidelines. Now, this borrowing costs in financial markets have dropped because of this to the lowest in a decade on the back of abundant liquidity. Because when you conduct repo operations, you're basically giving to the banks, and hence that is more liquidity in the system, right? So the excess liquidity in the system, lower borrowing costs, coupled with the deployment of TLTRO funds, have led to a record primary issuance of corporate bonds. That is, more banks are issuing corporate bonds now. So more money is flowing into the corporate world. And the primary issuance of corporate bonds have reached the figures of 2.09 lakh crores, which is huge. And this is just in the first quarter of 2021. And to enable better transmission of its monetary policy, this I've already talked about, RBI introduced long-term repo operations, under which RBI conducted term repos of 1 year and 3-year tenors rather than their usual tenors. So I've already talked about this. Since the banks are allowed to hold with them the money that they borrowed from the RBI for a longer time, they are able to give similar benefits. They're able to give similar benefits of lenient borrowing costs to their own customers. Right, because more liquidity in the system, they don't have to fear about going bankrupt. More cash reserves, basically. Now, the policy repo rate was brought down from 5.15% on March 27th, 2020 to 4% on March 2022. Now, this is huge again because of this, borrowing costs reduce, right? And this when borrowing costs reduce, more people take loans, and hence more people consume, which revives growth prospects. Now, the marginal standing facility rate was reduced from 5.40% to 4.25%. Now, what is the marginal standing facility? Now, the marginal standing facility is, now you may wonder, banks are already able to borrow from the RBI via the repo rate. So why is the marginal standing facility needed? Now, the marginal standing facility was a window created for commercial banks to borrow from the RBI in certain emergency situations when interbank liquidity dries up completely. Interbank liquidity, that is, they can't borrow from other banks. They are forced to borrow from the RBI and RBI only. And there is volatility in the overnight interest rates, right? Whenever there's volatility in the system, you would much rather borrow from the RBI rather than any other bank. To curb this volatility, RBI allowed them to pledge government securities. I've already talked about this. Government securities are collateral here, right? The RBI allowed them to pledge government securities and get more funds from the RBI. Now, the RBI rate is higher than the repo rate because they're not borrowing through regular channels. They're borrowing through a channel that's only to be used at emergency situations. And whenever you're borrowing from a channel that's only meant to be borrowed through at emergency situations, that means your credit rating isn't that high. You may not be able to borrow, pay back that loan, right? So the interest that they have to pay is higher than the repo rate in this case. Thus, the overall idea behind the MSF is to contain volatility in the overnight interbank rates. Yeah, the marginal standing facility rate was brought down. Now, this rate was brought down from 5.50% to 4.25%. But because this is an emergency time, right? The COVID-19 situation, it's a very uncertain time. And the reduction in the marginal standing facility rate means the borrowing costs are further lessened, even for banks that may or may not be able to pay back that loan. While the now the reverse repo rate under the liquidity adjustment facility was also reduced from 4.90% to 3.35%, which means the RBI too can now borrow from the banks at a lower rate. The reverse repo rate is the rate at which the RBI so and so borrows from the banks. Now, this is a concept that requires a bit more refinement, and I'm not going to explain the finer details of the very same here. So this was basically to lower borrowing costs and revive future growth prospects. Now, the CRR reduced by 100 basis points to 3% of NDTL. Now, those are two terms there, CRR and NDTL. What are they? CRR is a percentage. It's the cash reserve ratio. Now, we all know what cash reserves are, right? You have to. Every bank has to deposit a mandated amount with the RBI in case things go haywire. This is a percentage of the assets they have. Now, the percentage of assets to be, and these assets are kept with the RBI itself, so as to promote safety. Yeah, the CRR reduced by 100 basis points to 3% of NDTL. So when now the NDTL, it is the sum of demand and time liabilities of banks. The demand liabilities are basically liabilities that the bank has, such as demand deposits that can be withdrawn by the customers on demand. Or the time liabilities of banks are the liabilities such as bonds, let's say, or commercial paper that will expire, that will mature in a while. I'm sorry, the usage of the term was wrong. So now we are more well equipped to exactly understand this. CRR, or the cash reserve ratio, was reduced by 100 basis points to 3% of NDTL, which means, think about this. The RBI is basically reducing the amount of money that the banks have to keep with themselves, which means they're indirectly injecting this amount of money into the banks. Now, I've already talked about this. This means more liquidity, right? Because with more money floating around for people to play around with, more consumption and better growth prospects. Now, the reduction in the CRR led to an injection of liquidity of around 1.37 lakh crores. Now, this is huge, into the banking system, while enhancement in the MSF marginal standing facility enabled for them to better management of day-to-day liquidity. Now, apart from this, other regulatory measures that have been taken are deferment of interest on working capital facilities. Now, working capital facilities are the everyday needs of a particular corporate entity. Now, and they borrow short-term loans to facilitate their everyday working capital. So, deferment of interest on working capital facilities means they can borrow funds for working capital at lower rates, right? And this also leads to an easing of working capital financing, basically. And there have also been deferment of implementation of the net stable funding ratio. This is a concept that's a bit more complex. This was introduced in Basel 3. Now that's something that is beyond the scope of this conversation. We have already overstepped the time boundaries. Basically, it's a regulatory framework that ensures that banks keep more cash reserves. Let's understand it that way for now. It's a bit more simpler that way. This is basically for regulatory relief of banks, right? We don't want to pressurize them during the fallout. Now, banks are permitted to allow a moratorium of 3 months on payment of installments with respect to term loans. Kudligi has already talked a lot about what this is. Apart from this, Exim Bank extended a credit of 15,000 crores. Exim Bank was extended a line of credit of 15,000 crores. Now, what is Exim Bank? Now, this is a very interesting bank. Now, the Exim Bank is an abbreviation for Export-Import Bank of India. Now, this is a specialized financial institution wholly owned by the government of India, set up in 1982 for financing, facilitating, and promoting foreign trade of India. a very interesting bank to speak about. Now they were extended a line of 15,000 crore, which means they are now a line of credit is a very interesting concept, really, because we know about it very well, but we don't exactly think about it a lot. A line of credit, you have credit cards, right? Those are lines of credit. A line of credit is basically a credit facility that is extended to a borrower, wherein they are extended money up till a maximum threshold. Say if 15 crore would be, let's say they're extended a line of 15 of you're extended a line of 100 rupees, right? That means you are able to borrow from the bank until a range of 100 rupees. But if you exceed that amount, the line of credit no longer holds. So what is so you may be wondering what is different from a line of credit and a normal loan. Well, a line of credit, what's interesting about the line of credit is basically that it only charges you interest on the amount you have spent, which means if let's say you take a loan of 100 rupees and let's say you're extended a line of 100 rupees, you would pay the interest on all of that 100 rupees in the case of the loan. Whereas in the case of a line of credit, you would only pay the interest on the amount you've spent. Let's say you have an extended line of 100 credit and you've only spent about 90 rupees, right? You would only be charged interest on the 90 rupees, not the entirety of 100. So the Exim Bank being extended a line of credit of 15,000 crore is a good measure. This is to meet Exim Bank's foreign exchange requirements, especially in these uncertain times. Yeah. Now that's it for the RBI, I believe. No. There's one more important thing that we still haven't covered. Now, let me introduce what a consolidated sinking fund is, right? Before I get with this, this is a very interesting point. A consolidated sinking fund is a sinking fund wherein an entity deposits fixed amount at regular intervals, right? At regular intervals. So, for all the states have been recommended by the RBI by the Finance Commission, by the 12th, if I'm not wrong, to have a consolidated sinking fund, which they can later borrow from. Now, this consolidated sinking fund, of course, has to be is kept with the RBI, so as to not have arbitrary use of this fund. It has to be heavily regulated. So the rules regard governing withdrawal from the consolidated sinking fund for states have been eased to meet redemption of market borrowings. Basically, now the states can borrow from this consolidated sinking fund and have and meet their market borrowing requirements. Now, I have not gone over the measures taken by the Securities and Exchange Board of India because they're a bit complex and would extend the amount of time that we have already breached upon. We will have a conversation about this perhaps after this this video call, perhaps an informal discussion. But for now, I have not paid much attention to it because the concepts that I have to explain in that part are a bit complex, and we've already overshot our time limit per se. Yes, let me talk about about what the Insurance Regulatory and Development Authority of India, that is the IRDAI, have done. The IRDAI have issued 2 circulars and 1 press release as the lockdown was unfolding. In these circulars and press releases, they clarified that subject to policy terms and conditions, the health insurance policies cover hospitalization due to COVID-19. This is a very good step because now all health insurance policies must include COVID-19 as a cover should be met out to all health insurance claims made on the name of COVID-19. Another thing these circulars noted was the extension of grace period by 30 days for life insurance premiums payable in March 2020. This was later extended to premiums payable in March 2020. Now, what are premiums? Basically, whenever you take insurance, you have to pay a certain amount at regular intervals so that the insurance is validated, is given to you. So these are called life insurance payments, these regulated payments that you have to pay for the insurance scheme to remain validated. So the extension of grace periods by 30 years for these life insurance premium payments are a good are a good move, because I mean, people are hard pressed for cash right now, right? Now, the circular also simplified quick claim settlements procedures for COVID-19 related cases and daily monitoring of life insurance claim settlements due to COVID-19. They've basically increased the vigilance surrounding COVID-19 claims so that they can be meted out as fast as possible. Utilization of digital and alternative modes for premium payments and various other services during the lockdown have also been proposed. It is a good thing, because due to the lockdowns, you can't exactly pay money upfront. So this is a very good measure that way. These were basically for mitigating the effects of COVID-19 pandemic on the insurance sector. The Pension Fund Regulatory Development Authority, I've already talked about what they have done. Let me just briefly sum up what they have done. Given the COVID-19 induced disruptions and the ensuing work from home norms of employees, and the corporates, the employees were allowed to authorize NPS subscription registration forms. What are NPS subscriber registration forms? They're basically basically forms for registering in the NPS, which I've already explicated on before, right? National pension system. So these forms were allowed to be authorized by the employees through email rather than physical mode with certain conditions, which is, again, as I've already talked about, a good move, because with the lockdown conditions, it's not exactly viable for a physical mode of authorization. The Insolvency Board and the Insolvency and Bankruptcy Board of India, in the wake of the COVID-19 outbreak, in the wake of the COVID-19 outbreak, the Supreme Court ordered that the period of limitation in all proceedings shall stand extended still further. So what is the limitation in all period of limitation in this case? A maximum period set by a statute within which a legal action can be brought or rightly enforced is a period of limitation. A statute may prohibit, for example, any individual or legal entity from bringing in an action for breach of contract for more than 1 year after the breach occurred, for example. Yeah, so the limitation period has been extended till further orders. Now, this is because the Supreme Court has taken suo motu cognizance of the challenge faced by the country on account of COVID-19 and the resulting difficulties that litigants are facing in filing their petitions, applications, suits, appeals, and all the other proceedings within the period of limitation, right? Now, the Ministry of Corporate Affairs increased the threshold amount of default required to initiate an insolvency proceeding from 1 lakh crore to 1 crore. From 1 lakh to 1 crore to prevent MSMEs from being pushed into insolvency, especially in the wake of the COVID-19 outbreak. Now, how is this? This is pretty self-explanatory, really, because when you increase the insolvency threshold, you're basically saving a lot of companies from being deemed insolvent, right? Increasing the threshold to prevent MSMEs from being pushed into insolvency, basically, especially in the wake of the outbreak of the COVID-19 pandemic. The IBBI amended the IBBI Regulations 2016 and IBBI Regulations 26. The IBBI amended the IBBI Regulations 2016. The amendments provided for extensions in certain timelines prescribed under the regulations to ameliorate stakeholders' pain in the insolvency ecosystem in the wake of the COVID-19 outbreak. Basically, they've added new, these amendments, they provide for extensions in certain timelines prescribed under the regulations to ameliorate stakeholders' pain in the insolvency ecosystem in the wake of the COVID-19 outbreak. So that's it. I'm sorry if I bored you. Let me just conclude everything what I've just said. Overall, policy authorities have been responding to the COVID-19 pandemic across monetary, liquidity, fiscal, and financial regulatory domains to keep the financial system functional and well-oiled on one hand, and businesses and households viable and solvent on the other hand. However, the challenges that still remain are pandemic proofing in large challenges still remain in pandemic proofing large sections of the society, especially those that tend to get excluded in formal financial intermediation. Challenges still remain in unwinding the stimulus and support packages in a calibrated manner without disrupting the markets, and challenges still remain in re-establishing prudential norms in their pre-pandemic stance. So that's it. We are open to questions if you have any. I hope I have not bored you.
Okay, thank you, Saurabh, Vishwas, and Anjaney. You did a great job. And now we will move on to the present. We will move on to the questions. So, have there been past instances too, wherein the capital markets and the national economy have been in dissonance? Is there an opportunity to learn from them?
All right. So I don't know if there's a specific example, but a key example for that acts as warning was in 1929 Great Depression. In between, there was a time when the stock market started rebounding slightly, and everyone thought the worst of the crisis is behind us. However, then the stock market crashed almost by 80%. So the key learning that we get from this is we need to be careful, one, and the government need to continue the fiscal packages and the expansionary stance they be taking. We should not start to contract too soon, and the government should start keep giving money and keep pushing the economy for forward as long as possible, because it's better to go an extra mile than to be even 10 meters short. Next question, please.
Yeah. So in the next question we had, according to the efficient markets hypothesis, stock market prices accurately and completely reflect all available information about an economy's financial state. So does the discrepancy that you spoke about reflect that some information has been ignored on either side of the table?
Okay, so this is a very interesting question, right? Because a key feature that has been noted I'm going to focus on the American stock markets because I think that is what is representing the global scenario right now. A few group of stocks are are driving the stock market. So since the FANG, that is FAANG, the technology stocks, and some other like Netflix and one two more companies have done very well together, they pushed the stock market forward. So that is why the companies in stock market driving it do not represent the stock market itself. Second, the stock market also does not represent the whole economy, right? Because COVID-19 has more disproportionately affected small business owners, shop owners, barbers, whereas stock market is more affecting the top market, the bigger companies. And therefore, I believe that this hypothesis, while maybe true in some scenario, in this scenario is definitely not true, because the representative population of the stock market, the companies in the stock market and the economy are very, very different.
Okay. So next question: are the big bank PEs price to equity ratios justified given their relatively high exposure to NPAs?
Anjaney or Vishwas, would you like to take this question?
Sorry.
Would you guys like to take this question?
I do not. I do not believe I have enough qualifications to answer this. I'm sorry.
Uh, can we answer this at the end? I think we'll discuss with the other speakers and we'll come back to this question at the end.
All right.
So in the second slide of the presentation, you mentioned that if there has been a drop in risk appetite or the entire market as a whole has become more risk averse, doesn't that intuitively go against the constant bull run that the markets around the world are currently experiencing?
Okay, two reasons. This is a very good question. I've researched on this question. First, the reason that the stock market is going on a bull run is because the stock market is forward looking. Before the COVID-19 struck, the worst situation came, the market had fallen 2 months ago. Now, since while the situation is still bad in the economy, the stock market is already rising. That is because they expect what will happen in the future. Since the stock market is expecting that in the future the situation will improve, that's why the stock market is going up. Second, even though banks have become risk averse, the capital flows to the stock markets have not stopped. Why am I saying this? Because and this is a little logical, it is not a technical answer but a logical answer. Because sports have stopped, because horse riding has stopped, and places where people have bet have stopped. People have tried to bet in the stock market. More and more money is going to the stock market. For example, Robinhood, which is an app for the normal man to invest in the stock market in the US, has seen an unprecedented rise in the number of users. So therefore, even though banks are not providing the capital, the normal everyday man has stepped into the market and he's providing the capital. So that is why the stock market is in the bull run. One, it's forward looking. Second, even though banks are not providing the capital, someone else is providing the capital.
Okay. So next one is, what has been the impact on profitability ratios on banks in the current period? Are they as bad as other indicators of banks' financial health, of the general banking sector's financial health?
Okay, so yeah, I'll take this one. So yeah, like they are as bad as the like other indicators of the financial institution, and they have the profitability ratio. There has been a huge drop off, like since the like if we'll plot the last 10 years, so we can see the drop off. Like even in the financial crisis of 2008, the drop off in percentages wasn't this much as it is in this unprecedented shock of COVID-19.
Okay, and the last question with regards to what Anjaney mentioned. So you mentioned that the commodities trade will trade softer. You defined softer trade as there'll be more buyers than sellers in the market, right?
I would like to make a correction there. I stated that there'd be more sellers in the market rather than buyers.
Fine. Then this question is rendered null and void because the question was built on the assumption that there are more buyers and sellers in the market. Cool. So that brings us to an end of this particular presentation on RBI's financial stability. We thank all the attendees for sticking with us till the very end in this 2-hour, 22-minute presentation. And thanks for all the people who are viewing this later on YouTube or whatever platform we have posted it on.